Hey everyone, and welcome to Beating the Benchmark inside the investment strategy of Michael Gielkens. My name is Christian Lindvall, and I'm the Global Commercial Director here at Performativ. We are a portfolio management solution headquartered in Copenhagen with offices across Europe. Really grateful today to be joined by Michael, who has set aside the next hour to walk us through his investment philosophy and strategies, including a look at some of his largest positions, his views on technological and operational excellence, and then maybe even perhaps a quick glimpse into the future. There will be time for Q&A at the end, so feel free to submit your questions in the comment section as we go along. And then, Michael, welcome. Maybe you can start by giving us an introduction to who you are and what you do.
Christian, thank you for having me here for the inaugural podcast or webinar or live stream if it's LinkedIn Live. So looking forward to our conversation. Um, yeah, I'm a wealth manager, so I'm a co-owner of Tresor Capital, and we run diversified strategies mainly focused on let's say family-owned holding companies, but we'll get to that a bit later. Um, you could say investing has always been a passion of mine, a bit of a hobby, if you will. So I'm maybe more a hobbyist turned professional than the other way around. Yeah, I'm very interested in capital markets and have always been interested in learning more about businesses. So started investing in the financial crisis or shortly after the financial crisis, and actually started with an investment in Berkshire Hathaway.
Okay.
Credit to my colleague Maurice, who was in an investment club where I was as well, and he pitched the name there, or it was already part of the portfolio, and yeah, I started reading everything that Buffett wrote, and basically went on from there, and yeah, got fascinated by it. Uh, did a master's degree, but um, to quote Buffett and Munger, it's better to learn it their way during your studies and then do it their way afterwards. So if you want to beat the benchmark to get to the name here, so yeah, and then basically started in at the end of 2016 in Luxembourg at a wealth management company as an analyst. And in 2021, with three of my partners, we were able to buy a Dutch firm, and yeah, we were able to bring our clients and our strategies back with us to the Netherlands, and haven't looked back since. So now we've been co-owner of the company for closing in on almost 4 years now. So yeah.
Amazing. Thank you for that. Maybe a good segue into the background of philosophy. Can you walk us through the origin of the Tresor strategy?
Yeah, so actually, one of the first things I did was, or one of my first jobs basically was, can you analyze which strategies have been successful and which strategies maybe haven't been creating value for clients? And there were a lot of active investment funds where yeah, let's say the classic fee structure of 2 and 20 or 1.5 and 20, which were costing a lot of money but weren't actually creating any alpha. So that actually resulted in yeah, what actually did work, and it happened that companies like Berkshire Hathaway, these kind of holding structures, which happen to have very low fees, were among the best performing strategies. So yeah, you start researching there. There were a lot of other companies that were known and already that we were investing in, like Investor AB from Sweden, or Hull Trust from the Netherlands. So there we were aware that there were a lot of these kind of companies, and yeah, we started scouting more. And you see in Sweden there are a lot. You will see in Belgium there are a lot of these kind of companies, and that gradually transformed into a formalized strategy, which has been live since let's say January 17. And we've been yeah, refining it and optimizing it ever since.
Very nice. Then what was the moment you realized the power of family-controlled holdings? Was there an aha moment for you?
Um, well, it kind of clicked when you've already read a lot of the letters from Warren Buffett, or
Yeah.
you're moving a bit more into this kind of fundamental investing philosophy, that then it clicks a bit. So in the industry, there are a lot of people that are like, oh, we have 2 percentage points divergence from the benchmark, so we are an active manager, and we weren't even looking at a benchmark. We were just looking at, yeah, which kind of companies and which strategy was able to generate yeah, significant alpha for our clients. And I would say the first time that it clicked is when researching the Swedish market
Hmm.
and suddenly seeing, oh, we've found investor AB, but there are 10 or 20 similar kind of structures in Sweden alone, which have a similar structure, founder-led or a family controlling group, and they've all had a very, or most of them have had a good long-term track record. But I would say diving even deeper into Berkshire and Investor AB, I mean, Buffett's track record of over 20% since 1965, or Investor AB over 12% since 1919. uh, Total return. That's yeah, if you're compounding for 50 or 100 years at those levels, that will create enormous value. And
Right.
it immediately clicked that the family and the long-term ownership structure that they or long-term strategy that they allowed the companies to have was crucial for these kind of compounding journeys to become fruitful.
Yeah. And then I'm curious, I've heard this term, like, what does skin in the game really look like to you? I guess this is two parts. Like, what does it look like to you? And then why do you consider that non-negotiable?
Um, well, it's generally the solution to the principal agent problem, right? So as an outside shareholder, you don't know what the management is up to. In the end, you have to trust the management team. So Charlie Munger once said, "Show me the incentives, and I'll show you the outcome." Well, if your incentive is that you're working towards a, let's say, short-term bonus or something, your behavior is going to be different than when, let's say, over 80-90% of your personal wealth is invested in the shares of the company. So it's a matter of alignment, basically, that you create similar goals between the management team and yourself as an outside shareholder. It doesn't negate any bad things from happening, of course, or it doesn't mean that management will not have a it doesn't mean that management will not have yeah, make mistakes or something, or but it's a very important tool to know that, okay, the guys who are actually in the boardroom, or who are deciding on these big investments or building a new factory or buying another company, they are doing that with their own money and not just with our money as outside shareholders. So it's an important alignment of interest. And yeah, that's also the reason why we consider that to be non-negotiable, in terms of that's just the first step in our process. It's like within our investment universe, there are a lot of holding company type structures or serial acquirers which don't have significant insider ownership. Yeah, to be honest, for us, that's a showstopper, just because we want to make sure that when it's going well, that they're benefiting as well. But when we and our clients are hurting in our portfolios, that they feel the same pain.
Makes perfect sense. Yeah. So you walked us through the origin story of Tresor, but I guess how does your investing philosophy differ from other wealth managers?
um, well, yeah, it depends where you're looking at, right? I mean, I think
Mm.
it's a well-known fact that there is a lot of index hugging because of fear that you're going to underperform the benchmark. So if you're imitating the benchmark as closely as possible, and you have uh, a relatively low tracking error, but you still say, well, we have an active share because we have, let's say, maybe 2 percentage points more in a certain industry or geography. That's already considered to be an active approach, and we really try to be benchmark agnostic, and
Mhm.
we have to report the benchmark, of course, to our clients. We are legally obliged to do so, but it's not like we are saying, oh, the benchmark has over 25% in technology, so that automatically means that we have to replicate that in our strategy in order to be able to keep up with the benchmark. So I think that is a differentiating factor. But the most important thing is, I think, we have strategies that aren't common. So we try to give clients exposure to active fund managers if we think they can add value. Um, but especially our own strategy in house, of course, with the family owned companies. That's the main thing, I think, that sets us apart. But also in terms of, let's say, the past few years, for clients with a more risk averse risk profile, we've been able to, because we thought of bonds as return free risk instead of the other way around. So we stopped investing, or we didn't invest in bonds for our clients. Um, and we had hedge funds and these kind of things, which didn't have a significant drop in 2022, which allowed our clients to actually be able to fulfill their strategy in terms of, yeah, uh, keeping the purchasing power and their capital.
Right. And then we've talked before. You've used cash in a way that's both defensive and opportunistic. Can you actually walk us through how you think about cash allocation within the portfolio? And then maybe second to that, how has that played out in practice, especially during volatile periods like we've seen 2022? There was a selective rebound in 2023, and then again in 2025.
Yeah, well, we we aren't market timers, so we don't have the pretense to think that we can actually time the market, but we can see
Right.
what the stock prices are versus what we think the fundamentals are of our companies. And so in the past couple of years, we've owned Brookfield since, I think, 2018. Brookfield Corporation. Before that, it was Brookfield Asset Management, and they have this big real estate portfolio, and they are dependent on, let's say, markets being less volatile to be able to get their performance fee, so to realize carried interest, basically. And so investors were, in times of market volatility, they just say, we don't think the 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 real estate portfolio and the realizations from the portfolio are going to happen anytime soon. So we'll just put a zero value on that, and we've seen discount levels versus our view of value of over 50%. So there were times when Brookfield was over 10% in our portfolio, but there were also times when it was less than 5%. In 2021, when suddenly when interest rates were zero or even negative in Europe, yeah, the discount level was very close to our view of fair value. So all of a sudden, instead of buying a dollar for 50 cents, you were buying a dollar for a 96 or 95 cents. So we were like, that was a moment when we have significantly sold our position in Brookfield, and I would say interest rate sensitive companies overall. Um, so that was a moment when we kind of created cash within the portfolio, and which we were able to deploy then, of course, in 22 at more favorable levels. Truth be told, we should have just sold a lot of these low discount companies, and we held on to a few of them. So we did take a drop in 22. But because of active management in 22, buying these companies, which were, in our view, punished way too roughly by Mr. Market, we were able to get out of that actually quicker. So we've had since every large drawdown. Almost every large drawdown since the strategy has been live, we have significantly outperformed on the upside in the recovery phase.
Maybe a good segue into a strategic deep dive. Obviously, this is about beating the benchmark consistently. You've outperformed the global benchmarks consistently over time. If you had to distill that down, what do you attribute that to specifically?
So it's definitely been active management, that which I just mentioned. I think that has created a lot of value. We did an analysis recently for the first 6 months, and for our let's say January 1st portfolio, we've created over or close to 3% of additional return just by buying in April, buying in February with the whole DeepSeek drop. So I would say it's not timing the market per se, but it's been buying companies which fulfill the requirements to have an outperformance. So we look for companies with a return on capital of more than 15%. Well, if you return more than 15% and you don't pay too high a multiple, that's a formula for a good return right there. And then on top of that, we've tried to improve our alpha a bit in the portfolio by this active management.
Got it. So diversification, maybe simply good. There is the trap of over-diversification, in a sense. So how do you avoid the trap of over-diversification?
Well, we've put a limit on the positions in our mandate. So in our holding company strategy, we have a maximum of 25 companies. As of this moment, we have 22 companies live in the strategy, and we have a very big bias towards, let's say, the top 5 or the top 10. So structurally, the top 10 is more than 2/3 of the portfolio. And we've often had the situation when the top 5 was 50% or 45% of the portfolio. So we do take active approaches in terms of the highest conviction companies, and because these are inherently diversified structures in and of itself. So with one company, you're buying a portfolio of maybe 200-300 businesses. So it's already diversified enough. So we don't want to have too much individual lines in the portfolio. So it's definitely, if you buy 100 holding companies which own a couple hundred companies themselves, you might as well just buy the the world index, because you're unlikely to get a significant outperformance that way.
Yeah. And you mentioned high conviction. That sounds like it's a super important part of your approach. Is that fair to say?
Yeah, we want to put our money where our convictions are. So if we believe that, for instance, I mentioned Brookfield, we own Brookfield and KKR in our portfolio, and combined they're about 15% of our portfolio. We have a conviction that these are very high quality companies which can compound. They expect themselves in their capital markets day. They expect to compound intrinsic value at least 15% per annum. So, well, yeah, if you double every 5 years, that's not a bad thing in our view. And in April, we were able to increase our position in the drop, and recently we've actually taken some money out, because now we've seen a recovery a bit closer to fair value, but still attractive discounts to have significant exposure to those names. Another theme that we're playing is vertical market software. Recently, everything related to software has been punished because everyone thinks that AI is going to eat away software. So we've had talks with industry experts. One of our top positions is Constellation Software, for instance. We've recently made it our top position again, just because the market is indiscriminately selling everything that's software, whether you're Adobe or a vertical market software company which has very niche software. And we actually think that the development of software was never the mode. The development costs have been coming down gradually as technology has been improving, even before AI. But it's more the business relationships with your clients being ingrained into their systems, being mission critical, and having perfected your systems to your customers' needs for over 10, 15, maybe 20 years. And so if often that's less than 1%, the software package is less than 1% of your total enterprise costs, or 1% or 2% of revenue. Yeah, if you're a hospital, or you're a let's say a public institution, or you're a company, just because of a cost saving of maybe 20 or 30% because someone developed something with AI, are you going to transition to a new system and um, yeah, with all the risks, and it's not been tested live. You have to train everyone in your team. You have to put everything in a new data system. We think the market's reaction is very overblown, and so we've been actually increasing our position. So I would say software, vertical market software, is now a little over 20% of our holding company strategy.
Okay. Then how do you decide when to enter or exit a holding?
So, in Dutch, we've done a podcast a while ago, which was named "The Art of Not Selling." So, we the most important reason to sell is something is that we see a better opportunity come along, just a better reward, or maybe the investment case isn't there anymore. For instance, we had a stake in a company called Danaher a while ago, a big life
I'm
sciences
familiar.
a player, and our view was they are one of the the OGs in terms of serial acquisition, the strategy, and optimizing your companies. And yeah, now the past few years have seen some headwinds in their end markets, some more uncertainty about the long-term view, but also in terms of capital allocation. I mean, if you're a company which is worth with a market cap over 150 billion, and you're already a market leader, and given that, let's say, the antitrust bodies from governments are a bit more critical in terms of monopolists becoming bigger, um, yeah, it's becoming harder to see how they can still make over 10 or 15 or 20% return on investments on acquisitions that move the needle. So they're more becoming, you could say, an organic growth company. And then the long-term view has been, especially, let's say, in the US, with the, I'm not going to talk about politics, but let's say the US and the China markets are, from a geopolitical perspective, maybe a bit tougher for the next couple of years. And we found a company that was also in the industry in
Mhm.
Sweden, which was actually very attractively valued, which didn't have any exposure to these markets. So we sticked within the industry, but we moved to a Scandinavian company that we think has a better runway and a better risk return going forward. So that was a reason to make a switch. And yeah, the reason to buy something is, of course, that we think it's attractively valued. It's increasing the overall quality of the portfolio, the risk return potential of the portfolio, and that's something that we monitor very closely. So for every holding company, we have a bandwidth of, let's say, historical discounts to our view of intrinsic value, and we see how does it relate to the historic value? Is there a reason why this time could be different, or should we just stick to our discipline and maybe sell the company, buy it back at a lower valuation, or see if we have another company that we like better at a similar or more attractive valuation?
Now, you've previously mentioned the role of scenario-based valuation, optimistic, base, pessimistic. Can you give a real-life example of how that has shaped a decision for a Tresor?
So in our valuation process, we have let's say 5 scenarios that we develop, and one is like a very pessimistic scenario. We try to we try to be like, okay, in a long term negative scenario for the industry or for the market as a whole, what's going to be the outcome? So we have a depressed terminal value, we have a depressed growth rate, and that's usually the lower part of the valuation. And then you have a very optimistic valuation, like if everything goes right, and if they keep on executing, if they keep on being able to reinvest capital at high rates of return, then we could potentially get this return. What we do is we build in we assign probabilities to it, and our pessimistic, our conservative, and our base case scenario are always 75% of the probability of the total valuation. So we already skew to the conservative side, and then we still want to have a good discount to that value.
Perfect. Again, maybe then a good segue into your top holdings. So let's take a few of your largest positions. Why did you decide on these particular holdings?
Yeah, so our top positions now, both over 10%, are Constellation Software and Investor AB. So Constellation is, of course, you could say the one of the original serial acquirers. They've compounded over 30% since their IPO in 2005, and our conviction there is we don't think there is a management team and an owner operator which is out there with a better view of intrinsic value. He repeatedly tells shareholders, "Don't buy our shares because we are valued too highly." Which CEO does that? He hasn't earned $1 of salary since 2016, and he says, "I'm not your employee. I am your partner in this business." So that's a whole different mindset. Also, in the running of the business, he's always very objective. He says, "I'm the most thrilled when I actually when someone convinces me to change my opinion, versus having a dogma in your mind and thinking this is the way how we do it and this is how we will always do it." So the track record has been there. The growth of the free cash flow has been phenomenal. Return on invested capital has structurally been between 20 to 30%. And even at these levels now, especially after the recent drawdown of close to 20%, we feel very comfortable that we can hit our hurdle rate with Constellation. So that's why we've increased the position to our top holding again after decreasing it a bit earlier in the year because of the drawdown in April, where we saw some other opportunities. Investor AB it's a fantastic story in terms of helping their companies, the Wallenberg family, helping their companies being future-proofed, which means that they always strive to be the best in their industry. They always try to, for instance, with AI, in 22, when ChatGPT broke, first half of 23, the first thing that they did in their board meetings is, how will this impact our companies? And to what extent is this a threat? And they were already working on digitization and trying to get their companies as best in class in their particular industries.
Yeah.
And yeah, from an Investor AB level, they have an active management since 1856. The Wallenberg family is is controlling companies within the holding company. So they're now in their 7th generation, and it's been a phenomenal return, and they've actually been able to accelerate growth of intrinsic value this century to over 20% since 2000, which is a remarkable feat. And they they
Absolutely.
they consistently buy companies which add value to the portfolio. So they started a private company portfolio. Their IRRs are structurally over 15% for almost all of their companies. So it's a remarkable story of capital allocation, of stewardship of capital. And the most interesting thing is the family doesn't own the shares. The foundations of the family own the shares. So there can never be a fight within the family. And all the dividends that go out from Investor AB to the foundations of the family are invested back into society and research and development, or charitable causes in Sweden.
Right. And you mentioned serial acquirers. Do you think you evaluate them differently than the market typically does?
Um, yeah, it's hard to see how the market values them. I mean, you can do a reverse DCF and think what this is what they are considering as a reasonable multiple. Um, what we have transitioned to, I would say, is we've taken more of the learnings from Michael Mauboussin in our in our investment process. So the return that you're going to get it's basically you can calculate it back in a formula in terms of what is the growth rate, what is the return on invested capital, and what is the multiple that you could have paid. And many people start with, I don't want to pay a high multiple. And some of these companies are trading at 25, 30, 35 times trailing free cash flow, and people automatically say, well, this isn't an interesting company for us. Whereas when you can invest in, let's say, consistently get 20% on your reinvestments, and you're able to reinvest, let's say, 60, 70% of your cash flow, and the cash flows are growing 10, 15, 20%, then you're paying at this year's multiple maybe 35 times, but a few years down the road you're maybe paying only 20 times or 18 times, and all of a sudden it looks much more palatable. So we've, I think, transitioned a bit into what are the value drivers that investors are putting into the company, and what is our conviction in terms of, yeah, what the runway is. And there, I think we are differentiating ourselves a bit. Mark Leonard from Constellation Software once said, if you look at value investing is always buying something for a lower value than what it's than a lower price than what it's worth. But a special kind of value investing is a company that can grow for a period which is longer than people expect. And a very counterintuitive piece of research is that companies that have a very high return on invested capital are often able to sustain that over a longer period. So where people are looking for a reversion to the mean in terms of, I would say, the more classical type of value investing or deep value investing is buying something in an industry which is trading at, let's say, 10 times, and you're buying one of their companies at 6 times. You wait for the re-rating, you sell it, and you look for something else. Whereas these companies are, as long as the runway of reinvestment at high rates of return is still intact, you can basically have this compounding journey over a very long time period. And I think that's where the study of multi-baggers or 100 baggers came in, that companies that returned 100 times the initial outlay of an investor, um, and a lot of these companies have yeah, been able to keep uh, yeah, beating the expectations, if you will. So that's definitely been the story for Constellation, for instance.
Yeah. I'm really keen to understand, really curious, how you view downturns. Like, do you hold through downturns, or are there triggers that make you reduce exposure?
In a company or in the market in general?
I guess for both, but let's say market in general.
Yeah, so the market in general, it really depends on if the fundamentals are intact. So one of the things that we look for are companies that are able to get obtain a good, let's say, earnings growth throughout the cycle. So you could say companies that are a bit less cyclical, and so they should be able to keep on earning. Yeah, if that is in a downturn, if that is proven to be not the case, or if for some reason our view of risk return going forward has been impaired, uh, we are willing to sell a company to buy another company if we think that it makes sense from a portfolio level. And it's similar for an individual company. I mean, if we think that a company is unjustifiably beaten down, like the whole software industry in the past, let's say 2 or 3 months, um, then we always have in our investment committee, we always have someone playing devil's advocate. Like, yeah, what if the market is right on this? What is our differentiating view versus the market? And uh, if we're increasing our allocation, are we increasing our risk, or are we being contrarian and saying, well, the market isn't correct? So, for instance, earlier this year, we initiated a position in Alphabet, the holding company on top of Google and YouTube and Google Cloud and all these businesses. Um, and we had the view that Alphabet was always working on AI. If you listen to the recent acquired podcast on Alphabet, at some point all the major players in the AI space were actually housed within Alphabet. So it kind of originated there, you could say, the whole idea of generative AI, and the idea that Alphabet was going to be missing the AI train. We were very skeptical about that. At the very least, they would be one of the beneficiaries, maybe not the winner, but definitely one of the beneficiaries of AI, because they've been working with DeepMind, they've been working on it, building out the cloud, working on their own processing chips, the TPUs. So when DeepSeek hit, we were like, this isn't. And uh, at that time, Alphabet said, "Well, we're going to invest 75 billion into data center build out." Yeah, well, investors were like, we have this company in China that's able to do it with much lower costs, much lower capital investment, and here you are building out capital. And we were also thinking, at the very least, Alphabet needs these data centers for their own operations with search, with YouTube. So they are going to need the capacity anyway. Maybe they are a bit too early, but all the indications are that that there's much more demand than they can build out data centers. So we initiated a position, and then we got the April tariff tantrum, if you will,
Mhm.
and every American stock was beaten down very significantly, including the technology companies. Um, and European companies were fine. So that was a trigger for us to say, hey, we have some very nice gains on European companies, which are trading close to our view of, or closer to our view of value. And we have these American companies where Alphabet, Brookfield, KKR were trading at discounts of 30-40% of our view of value. That was like a very attractive moment
Yeah,
to buy them. So it's always situation dependent, but yeah, we try to do our homework so that we're ready when markets start moving.
makes sense. Um, Maybe switching gears a bit towards technology and operational excellence. We obviously have a partnership with Tresor providing a portfolio management solution, but how does a technology like ours actually fit into the long-term strategy for Tresor?
Yeah, the reason for us buy the system of Performativ is basically that we wanted to have a best-in-class service for our clients. So we've got a lot of responses from our clients that they use their banking app to log into their system. And then they have separate reporting, separate which it's all a bit of a it wasn't optimal. Let's just call it that way. And we were scouting the market already for a system, but we were never really convinced that the systems that were in the Dutch market were actually of added value. Or we've heard a lot of things like, "Oh, this isn't that customizable." And then we heard about you guys, and we were like, "Hey, this is a tailor-made solution, which we can employ for our clients. We can get our own app, so the clients can put all their banking information, but also the non-listed um, investments. They can put it all on the platform. They can all optimize the app to their heart's content, and basically build a customer relationship management system within that system as well. So for us, that was like the holy grail of a solution. That's why we were that's why we thought this was a very important next step in becoming not only let's say top level in our investments and in the efforts we put in our research, but also in terms of the service for our clients, and that also includes technology. And I can just say we were very impressed with the system that you guys built. So for us, that was a very logical next step to get on board with Performativ.
Yeah, I guess then before you kind of jumped into the digitalization project, how were you ensuring transparency and clarity when communicating performance and risk positioning to clients in the past? Was it all just purely manual work on your end?
Well, we of course used the reporting from the custodian banks that we
Right.
that we use, but to put a benchmark next to it and to have our own, let's say, reporting system, that was a lot of manual work. So we were ripe for let's say a digitization, but we wanted it to be a perfect fit in terms of our view of what we want such a system to do, and your view of uh, customization was much more than what the incumbent players in the market were offering. And I believe you're growing quite nicely in the Netherlands as well as a result. So
We are. Yeah.
I don't think we are the first ones, and I don't think we're going to be the last ones to use your portfolio management software.
Yeah. Fantastic. I guess before we get to, we have some questions from the crowd, but I think maybe one question on looking ahead, kind of glimpse into the future, as I mentioned in the start. Are there signs that the market is undervaluing family holdings again? Keen to hear your take on that.
Um, I would say yes. Our current portfolio has a weighted average discount of about 25-26%. That used to be closer to 20. And we've added a couple of companies that have historically had a lower discount level. So you could say that our current discount of the portfolio, so the difference between what we think the value is versus the market price, is much higher than what it used to be. Um, we've seen that increasing actually this year. That might be uh, a bit of a view of myopia from the market, that it's all about AI and big tech companies, of which we only own Alphabet. So talk about distinguishing ourselves from the benchmark. But I would say the market is generally, especially regarding the software companies, but also regarding holding companies in general, If you look in Sweden, for instance, there used to be holding companies trading at a premium of one example was a holding company trading at a premium of 80%, and that's dropped to closer to 10% right now. Investor AB, we think a reasonable bandwidth is between 5 and 15%. Last year we were around 5, 6, 7% for a longer period, and now we're closer to 15%. So now we're at the top end of our range, and we have a lot of holding companies that are above our let's say normal bandwidth of a discount. So I would definitely say the market is undervaluing these types of companies and structures at the moment.
Yeah. Perfect. Let's end it there. Thank you so much. That was an amazing deep dive. So very much appreciated. But there are a few questions from the crowd that I would like to get to here in the next 5-10 minutes. First one is, how do you approach emerging markets? Like, do you find the same quality of family ownership outside of Europe?
It's a bit more difficult in emerging markets. Maybe a story I can tell is we used to own a company called Jardine Matheson. The Keswick family owns that company. They were actually historically speaking, part of the opium trade, but let's not dive into that part of the history. But you had two holding companies, Jardine Matheson, Jardine Strategic, and they owned shares in each other. And when Jardine Matheson's ownership of Jardine Strategic would cross the 85% threshold, that would result in a mandatory buyout. And that happened closely after the COVID drop. We had already sold out, including dividends. We recouped our initial investment, but basically it was a sideways investment. So that wasn't a great home run. But I think our cost base was about $36, and they took the company private below that even. So after COVID, there was a bit of a mismatch in pricing for emerging markets shares, and I view that basically as an expropriation from the outside shareholders versus the shareholder-friendly management that we are looking for. What makes it difficult to invest in emerging markets is that you have more the tendency that these vehicles are used to perpetuate the wealth of the family, and for them to have something to do basically, and to earn a high fees, high income. So we have come back from playing emerging markets directly, and we now do it via companies that are listed on Western markets. So particularly North America and Europe, but also open to countries like Japan or Australia.
Cool. Another question from the crowd here. Do you have personal relations with the management of your holdings? And how do you make sure your judgment isn't biased because of those personal relations?
The answer is yes. So we try to visit our companies, visit the annual shareholder meetings or capital markets day.
I think we have you back.
Did we
Sorry, I
lose
think we
connection
dropped
there?
for a sec there.
Sorry about that.
Yeah.
Yeah. No
No,
worries.
it's okay.
You could say that we are biased in that respect, that it biases you. You're not independent anymore. But I think more and more that the distinguishing characteristic, if you're looking at countries which you can invest in for a 10, 20, 30-year period. I mean, on the short to medium term, you could say short-term earnings is relevant. Let's say for a 3 to 5 year period, or maybe even 10-year period, the returns on invested capital and the reinvestment rate are important. But longer than 10 years, I would say the most important factor is the culture and the management team. So we actually want to get a sense of, are they saying the right things, or are they also meaning what they say? And sometimes you think, well, they are saying all the right things, so it sounds too good to be true. And then in the end, you have to see their actions. You have to see what they're working on in practice. But I think that this is maybe the most important factor deciding the longer term returns that you're getting, because even though they might have skin in the game, in the end, you're not in the boardroom or in the management room every single day, and they are. So they are the ones that make the decisions that, in the end, decide your returns as an investor.
Makes sense. We have a couple of more fantastic long form questions from, I hope I'm saying this right, Matisse Snyders. He also asked, you spoke about the inherent advantages of holding structures. So is Tresor Capital itself structured as a holding company, or is it structured like a normal fund, and why?
We currently actually don't have a fund, but we are looking into that. So we are just a normal limited liability company, in which myself and 3 others, via our own holding companies, our personal holding companies, own the shares. But we are looking to set up a fund. So we currently work via managed accounts, so discretionary mandates, which basically means that someone is interested in one of our strategies, and we get the mandate on a bank account. So there's an agreement between the client and the bank. There's an agreement between the bank and us, and there's an agreement between us and the client, which decides that those are the rules of the game, how we can invest for that client. And we are currently investigating or researching the launching of a fund for our holding company strategy, particularly because there's been a lot of interest from clients. So to be able to buy that without maybe having a managed account with us. So that's definitely something to keep in mind going into 2026.
Fantastic. I think we'll end with one last one here. This is also a multi-part question. So how do you measure the underlying return on capital of businesses? And then you use the Buffett-like return on tangible capital, some accounting adjustments to capture the implicit intangible investments that businesses are required to expense directly. I can also repeat that if you need.
No, that's fine. I can read it in the chat actually.
Yeah,
so no, it's company specific. So for instance, for serial acquirers, especially for software serial acquirers, VMS companies, they buy other companies, and yeah, the fair market value is much higher than book value. So if you're just using a book value, or you're using a goodwill, or some companies activate intangible assets indeed on the balance sheet, and then write that down, or amortize it. Yeah, that's something that we try to make adjustments for. So I mean, for a holding company, the return on capital is just our view of the sum of the parts, and the let's say the potential earning streams that come from that. So you could call it, Buffett once named that, look-through earnings. And for serial acquirers, it's much closer to a measure of free cash flow, if you will. What they could I think Constellation Software and Lifco have a very good. Lifco is a Swedish serial acquirer. They've got a very good metric. Constellation says we have the free cash flow available to shareholders, while Lifco has they call it the free cash flow after after capex, but before acquisitions. So they could buy other companies, they could buy back shares, they could invest or pay out more dividends. So that's, let's say, the discretionary capital. And to some extent, most holding companies or serial acquirers could or definitely should report such a metric. You could say for Brookfield and KKR, for instance, that is distributable earnings before realizations. So those are metrics that give you a sense of the growth of intrinsic value per share over time. So it really is company specific, dependent on which metrics you use to measure that.
Perfect. Michael, thank you so much. Let's end there. Everybody who entered the questions in, thank you so much for participating and joining our very first LinkedIn Live. We will be back for sure with more LinkedIn Live episodes. And again, just to end it, Michael, thank you so much. It was a great chat.
Yeah, thank you. It was an honor to be the first one, and
Absolutely.
yeah, let's keep in touch and maybe do this again sometime.
Sounds great. Thanks so much, and thank you all again for joining. Cheers.